Joining me now to discuss, John Lonski, Managing Director and Chief Economist at Moody's, and Lippau Oil Associates President Andy Lippau. Andy, great to see you in the flesh.
Well, thanks for having me here in New York.
Let's talk about this precipitous free fall in crude oil prices, because about a month and a half ago, maybe less, the overarching conventional wisdom was $100 West Texas, here we come.
Well, you can see the conventional wisdom was wrong once again. But what has actually happened since then is a couple of things. First of all, U.S. oil production is at a record. At the same time, Russian oil production post the Soviet era has now moved up to a record. At the same time, the market was anticipating that the sanctions on Iran was going to really bring oil sales out of that country to next to zero. But what we have is 8 waivers that are allowing oil to be on the market. At the same time, the supply disruptions we've previously seen out of Nigeria and Libya, well, those have subsided, and both of those countries have higher oil production. As a result, oil prices are now down 20% compared to a month ago.
We're used to volatility in the oil patch, but this is a lot. This is pretty extreme. This is the kind of stuff you see, with geopolitical events, and that's not necessarily what we're having here. But I'm wondering, can we be too successful? The oil prices go up, we start to bring on these rigs online, and all of a sudden they plunge like this. Is there an equilibrium where we could probably reach? Because it's not helping the market today, John.
Yeah, my first answer to that is pretty quick, and that is this creates potential problems for those highly leveraged independent oil and gas exploration and production companies. We did run into some difficulty with that industry when oil prices collapsed back in late 2015, early 2016. Perhaps that's happening again. But I want to add, this drop in oil prices and drop by industrial commodity prices in general, including copper and whatnot, that points towards a slower world economy. When you combine a slower world economy, lower commodity prices with a stronger dollar exchange rate, you've got to scratch your head and ask yourself just where the inflation risks are coming from.
Yeah, that's what a lot of investors are asking Jay Powell today. So where do we go from here then, Andy? Because those drivers that you talked about more or less are in place for the moment. In the past, maybe Saudi Arabia, OPEC, Russia, they could make adjustments. They could flip a switch. It doesn't feel like they can flip that switch anymore.
Well, actually, I do feel like the oil market is putting a bottom in place, because these lower oil prices are forcing Russia and Saudi Arabia to come to a decision to reduce oil production. And we're going to see more talk and more headlines about that over the next couple of weeks as we go into an OPEC meeting in December, because clearly all of these OPEC member budgets are being busted at these lower prices. They need the money.
One thing is the market, right? So you got some major stocks, and it's not helping the Dow off 280 points here. Where's equilibrium? Where's a place where we know that oil prices can continue to create these great American jobs, and gasoline doesn't necessarily hurt the American consumer, that they're not at odds with each other? Is there a magic number, $70 a barrel or something like that?
Well, it's not $100 per barrel. That's too costly. Maybe it is about $70, $75 per barrel. But I wouldn't be surprised if over time the price of oil remains in a range $65 to $75 per barrel, despite these predictions of $100 per barrel oil.
Whatever happened to peak oil?
Peak oil? Well, we've talked about it for many, many decades, but the fact is that oil is the transportation fuel that is easily distributed around the world, and as a result, we're seeing, while growth in the U.S. might have slowed, growth in oil demand around the rest of the world is growing. So we're really not at the peak oil stage yet. It's going to be a number of years away until the technology for, say, electric vehicles or other alternative fuels improves to reduce the price of, say, electric cars and get that grid in place.
All right, we got to leave it there, guys. Thank you. Well, you always want to. I always look at John's face. He's always got one more great nugget for us.
The market is dropping overall. It's not just those stocks with exposure to oil prices that are falling. We also have another decline by housing sector share prices, and that has very little.
Which is another reason you wonder why the Fed's pushing this so much. Thank you again, Andy and John. Really appreciate it.